So, what if I told you the real secret to making money in the market isn't about finding the next big thing, but about mastering your own brain? That's really the big idea behind one of the most legendary finance books of all time, Benjamin Graham's The Intelligent Investor. We're going to break down its timeless wisdom right now.
First things first, to really get what Graham is saying, you have to understand the world he was pushing back against. You know, Wall Street. It often feels like a giant, high-stakes casino, right? It's just this chaotic storm of flashing numbers, breaking news, and gut feelings. It's a place that seems to reward chaos and promise you get rich overnight.
But here's the cold, hard truth of that game. The math is just brutal. If you lose 95% of your cash, you don't need a 95% gain to get it back. No, you need a mind-blowing 1,900% gain just to break even. Chasing those wild bets can put you in a hole so deep, it's not a setback. It's pretty much game over.
Okay, so that leads us to the most important question, doesn't it? If the way most people play the market is just a huge gamble, how do you even take part without risking, well, everything? How do you actually build wealth safely and steadily?
For literally millions of people, the answer has been this book. It was written by Benjamin Graham, a guy who actually lived through the Great Crash of 1929 and saw it all firsthand. The Intelligent Investor isn't really about picking hot stocks. It's more of a philosophy, a guide for financial survival and success.
And if you need a cosign, well, the book's biggest fan is maybe the most successful investor ever. Warren Buffett found this book when he was just 19 years old, and to this day, he calls it the best book on investing ever written. It's the foundation of his entire empire. I mean, you can't get a better stamp of approval than that.
Buffett, in his own intro to the book, just hits the nail on the head. He says success isn't about having a genius IQ or getting some secret tip. It's about two things. First, you need a logical system, a framework for how you make decisions. And second, you need the emotional discipline to actually stick to that system, especially when the market is going completely crazy.
So to build that framework, Graham starts with a really critical distinction, one that, honestly, it feels like Wall Street has totally forgotten. He makes you ask yourself a simple question. Are you an investor or are you a speculator? And believe me, your answer changes everything.
This right here is Graham's classic definition. It's so clear. He gives you 3 tests. Test number 1, thorough analysis. You have to do the work. Test number 2, safety of principle. Your first job is not to lose money. And test number 3, an adequate return. Notice he says adequate, not insane. If you skip even one of those 3 things, you're not investing. You're speculating. Plain and simple.
And when you put them side by side, the difference in mindset is just night and day. The investor is looking at the actual business behind the stock. The speculator, they're just watching the squiggly lines on a chart. The investor's priority is protecting their capital, while the speculator is all about high risk, hoping for a home run. And maybe most important of all, the investor is happy with a good, solid return. But the speculator, they're always chasing that one lottery ticket that'll change their life.
All right, so you've decided, okay, I'm an investor. Smart move. So what's the playbook? What are the actual rules of the road? Well, Graham boils it all down to a few really powerful common sense ideas.
You can kind of think of his whole system as being built on 5 big pillars. First, remember a stock isn't just a ticker symbol. It's a tiny piece of a real business. Second, the market is like a moody business partner, swinging from crazy optimism one day to total despair the next. Third, it's simple math. The more you pay for something, the less you're going to make. Fourth, and this is a big one, you have to always insist on a margin of safety. And last, and maybe most important, how you behave matters way more than how the market behaves.
Let's just zoom in on that margin of safety idea for a second, because this is the core concept of the whole book. All it means is buying something for way less than it's actually worth. That discount is your cushion. It's your financial seatbelt. If you're wrong, and we all are sometimes, that margin of safety is what protects you from a catastrophic loss. It is the exact opposite of that fear of missing out that drives so much of the market's craziness.
And that final principle, the one about your own behavior, that's where Graham hits us with his most profound and, frankly, most difficult lesson. This is where we stop looking at the market and start looking in the mirror. I mean, just let that sink in. You can do all the spreadsheets and research in the world, but it's totally useless if you can't control your own emotions. It's the greed, the fear, the impatience, the ego. Those are the things that turn a good plan into a total disaster. The real fight isn't you against the market. It's you against you.
And if you think, oh, I'm too smart to fall for that, well, let me tell you about one of the smartest people who ever lived, Sir Isaac Newton, the guy who literally figured out gravity,
Turns out, even he was no match for the madness of a market bubble.
So here's what happened. It's a perfect cautionary tale. In early 1720, Newton sells his shares in a company, and boom, he makes 100% profit. A brilliant move. But then, he had to watch as his friends kept holding on and got even richer. The FOMO kicked in hard. So he jumped back in, buying at a much, much higher price, right near the top. The result? He lost a fortune, the equivalent of over $3 million today.
And that story just perfectly illustrates Graham's ultimate point. It wasn't Newton's incredible IQ that failed him, it was his temperament. He let the emotions of the crowd take over his own sound judgment. Being an intelligent investor isn't about being the smartest person in the room, it's about being the most disciplined, the most patient, the most humble. It's not a trait of the brain, it's a trait of character.
So I'll leave you with this really simple analogy that Graham gave us to think about our own actions. He said, when you buy groceries, you focus on price and quality. You're looking for value. But when you buy perfume, you're paying for the fancy bottle, the hype, the emotion. So the question you have to ask yourself every single time you invest is this: am I buying groceries or am I buying perfume? Answering that one question honestly, well, that's the beginning of wisdom.